Hey folks, welcome back to another episode of Malcolm on Money, where we decode some of the more complex financial topics folks tend to run into in an attempt to simplify it and make it as plain as simple. And today we're going to be digging into how to avoid making a mistake when you roll your old 401k into an IRA or individual retirement account. So if you recently changed jobs or you're currently considering an offer from a new one, you've probably thought about your new salary and benefits package, the commute, and perhaps even how you'll reward yourself for a job well done. But there's a good chance that you may not have given much thought to what you'll do with the money accumulated in your former company's 401k plan. And if you're changing jobs or retiring, it's important to know the rules regarding moving funds from your employer sponsored retirement plan into your new destination for those funds. Because once you've submitted the rollover paperwork, that toothpaste is out of the tube and there's no going back. The wrong move could cost you in your income taxes and early withdrawal penalties as well. Anytime you leave a company where you've contributed to the 401k plan, you have three options regarding what to do with the money you've saved. You can either roll the balance into your new company's plan or another tax advantaged retirement savings plan. You can leave it there, or you can liquidate it and receive your entire balance in cash. If you choose to cash out the full account's value and have them mail you a check, you should research and consider the full tax implications first. But if you've chosen to roll the funds out of the former company's plan, there's two basic ways to move those retirement assets from one retirement plan to another without any tax consequences. With a direct rollover, your financial institution or plan directly transfers the payment to another plan or IRA. No taxes are withheld, and your account continues to grow tax deferred. This is the preferred option, and I'll explain why in a second. But the other option is what's called an indirect rollover, where a check is made payable to you directly and you have 60 calendar days to deposit it into a rollover IRA. After that, the entire amount is considered income to you and subject to ordinary income taxes in the year you executed the rollover. You could also face a 10% early withdrawal penalty depending on your age at the time. And indirect rollovers can be subject to a 20% automatic withholding, whether you want it or not. Sometimes the plan rules require them to do this. So as an example, if you had $100,000 eligible to roll over, your former employer would have to withhold $20,000 and you'd get a check for $80,000. But if you wanted to make sure the entire $100,000 made it into the new account, your only option would be to make up that $20,000 that was withheld from your own resources. You'd have to deposit the entire $100,000 into that new rollover account within that 60-day window. And then when you went to file your income taxes the following spring, you'd be eligible to get back the $20,000 you had unnecessarily withheld, probably as a refund. But how annoying would that be? That's why I'm a fan of the direct rollover instead. It's simple, it's clean, and it keeps you from making one simple mistake. Now, one thing you should be aware of, in case you did make some sort of mistake getting those dollars into the new company plan or into that rollover account within the 60 days, there is a fix. The IRS generally will allow you to throw yourself at the mercy of the court, or in this instance, the mercy of the Internal Revenue Service. And they even have a form letter available on the IRS's website that contains the 11 allowable excuses you can use for why you couldn't get that money into that account on time. It's on the honor system, so as long as you feel okay attesting that you meet one of those requirements, they generally will take your word for it. But who even wants to go through all that? One thing to know is that just by having the check made out to your individual name counts as an indirect rollover. So what you really want is to have the check made out to your new custodian, whether it's Fidelity or Schwab or Vanguard or whoever. And that way you technically never receive the funds directly, even if they mailed you a check to your primary residence and then you had to deposit the funds. It also allows you to preserve your once per calendar year eligibility to make an indirect rollover and stick within that 60-day rule. So I guess I should also point that out in case you didn't know that coming into this. You only get to make that indirect rollover one time each calendar year. But the best way is to make the request electronically and have those funds transferred directly between those custodians. So as an example, if your 401k plan was at Fidelity at your former employer and you want to roll those funds over into an IRA at Vanguard, let's say, the absolute best thing you can do is have Fidelity transfer those funds electronically over to Vanguard and bypass you entirely. Now, sometimes companies will say we have to mail you the check, And that's when what I was talking about with having to make the check out to the new company, the new custodian comes into play to avoid, once again, what's technically considered still an indirect rollover if your name appears on that check. So to drive this point home one last time, a direct rollover helps you to avoid the temptation as well to spend your savings and ensures that that retirement money makes its way into its intended destination. That's just one byproduct that, it's not part of the technical conversation, but also worth considering. And with the direct rollover, all you have to do is provide your former employer or plan administrator with the new financial institution's name, address, probably an account number, and deposit instructions, and you're good to go. At your instruction, they'll send your distribution directly to your new IRA or your new employer's plan. That way you can have confidence that you won't lose any of your account balance to taxes, penalty, or as I just mentioned, the temptation to go on a shopping spree. Lastly, one more thing I want you to be aware of is that whether you choose a direct or indirect rollover into your new company's plan or an IRA, you should also be careful to check and make sure that any after-tax contributions you once made to your former employer's plan is rolled over to a tax-free Roth IRA. If you mistakenly commingle those after-tax and pre-tax contributions in the same pot, it can be a nightmare to get sorted out later if they even allow you to fix the error. All right, folks, that's it for today's episode. Hopefully you learned something new and feel compelled to like, subscribe, or whatever else you're supposed to do on here. But more importantly, I hope you found this information valuable enough to share it with someone else you know. And if you'd like to receive more content like this directly into your inbox every week, then be sure to sign up for the Malcolm on Money newsletter at the address in the show notes below. And if you'd like to send us any comments or concerns or kudos or ask a question, feel free to shoot us an email at hello@malcolmethridge.com. Thanks for watching.